channel. My name is Tabitha. If you're new to this channel, please subscribe. Today we are going to talk about stock. Stocks is a ownership certificate of any company. What I mean by that is if public company, private companies, small companies, startup companies, pump and dump companies decide they want to raise funds, so they will invite the public to own part of their company, and this is what they call ownership certificate, and that's what is called stocks. So they will give these stocks to the public, and the public will buy them at a certain price with the promise that the price of the stock will increase in the future or maybe within a day. And when the public buy them, the number of the stock that they have bought will represent the percentage of ownership in that company. Public can either sell it. Public will decide to sell the stocks whether the price is up or down depending on individual need or the reason why they want to sell the stocks. Some companies also do give dividend, which means regardless of the stock price, whether it's going down or up, they will still pay a certain cash every month or quarterly. General public can easily trade these stocks online. It exchange hand between all the traders. So this is how this chart looks like. So this chart represent stocks, and this is what everyone is familiar with. So it goes up and down, up and down, up and down, within hours, within 2 hours, within a day. So it goes up and down, and that's why it's so volatile. So if you are invested in risky stocks, you should always be there watching it and see whether it's really safe for you to keep your money there or sell it. Shares. So shares refer to the stock certificate of a particular company. This is like when you go to a particular company and you buy number of shares of stocks in that company. So it's just like stocks put together, they make up shares, just like a similar word. Type of stocks. We have common stocks and preferred stocks. Common stocks, these are the ones that are traded in the public stocks exchange, like Toronto Stock Exchange or the New York Stock Exchange. They either receive dividend or they can also get capital gain, and there are different type of common stocks. Preferred stocks, on the other hand, they get fixed dividend. They are treated better than the traders who are having common stocks. They are the one who get paid first. You get them through agreements and all type of, because you have to go direct to the company, so you can sign agreement, and every time there's a dividend payout, you are considered first if you are preferred stocks shareholder. Common stocks, they have different type, which is dividend stocks. The dividend stocks is you bought stocks of the company, and regardless of whether the price is going up or down, the company will still pay you money quarterly or monthly. These stocks are much safer than the growth stock or penny stock. They can also see capital gain. So example of companies for dividend stocks are like financial institutions, just like in Canada, the CIBC, BMO, and RBC are involved in dividend stocks. So if you buy shares from CIBC, you will be expecting to receive some cash payout every month or quarterly. Most banks they pay their dividend quarterly. Utilities and energy like Enbridge and Fortis, they also do quarterly dividend payout. And we have telecommunication companies like TELUS. We also do have REIT, which are all deal with real estate. So those type of company, they pay monthly dividend. Some people, they can reinvest their dividend for the long term. So instead of them getting the cash every month or every quarter, they can reinvest that dividend, which will increase the number of shares they own or the amount of dividend that they receive every quarter or monthly. Growth stocks, on the other hand, they mostly concentrate on capital gain. So you buy most traders, they buy them low when the price has gone down, and then they anticipate that the price is going to go up in the near future. And some of them, they do pay dividend too, but others only depend on capital gain. We have example of companies for growth stocks. These are like Amazon, Facebook, Tesla, Microsoft, Shopee. So all these are growth stocks. So you're not expecting anything every month, but you have hope. You have done your analysis. You have looked into the books of the company and see that they have potential growth in the future. So you have put your faith in buying their stocks and hold them so that you can see that growth and you can be able to sell so you can make a profit. And that profit is what they call capital gain. We have penny stocks, which are also growth stocks. So this stock that traded under $5 or even $1, and these stocks are deemed to be more risky, the most riskiest stocks ever, and they are issued by small cap companies, those that are going bankrupt very soon, or maybe some good companies that you really not sure whether they're going to grow, stay in business, or go out of business. So penny stock. Penny stocks companies also, some of them can practice pump and dump. Pump and dump is when a company decides to hire inexperienced traders who can go and spread wrong information about their stocks, and when now the public get to notice and they buy the stock and the price goes up, and they will decide now they are dumping the stocks, they withdraw, and and most most traders lose their money. Example companies for penny stocks like Payto Exploration, Development Corp, Tox Oil and Gas, Fast Mining, Gold Corp, and Shell. Gold.